Investment in India, particularly through private equity and venture capital funds, has a time limit. According to SEBI rules, the investment funds must be liquidated in 7 to 8 years. Hence, investors mostly look for high returns in a short span of time. According to a report by a financial daily, SEBI is mulling to allow permanent capital vehicles or PVC. This will essentially allow asset management companies to stay invested in a company for several years or even decades. Investment through PVCs is a common practice in the USA. For example, Warren Buffett's Berkshire Hathaway has remained invested in Coca-Cola since 1988. Buffett has then bought $1 billion worth of shares. Although Berkshire Hathaway traded on the shares multiple times, it maintained Coca-Cola in its portfolio. As of 2022, Berkshire Hathaway had 400 million shares of Coca-Cola. The question here is, why doesn't India have propositions of permanent capital vehicles along the likes of Berkshire Hathaway?
Though the likes of perpetual funds like Berkshire and Fairfax have been in existence for long, apart from the two funds of IFM and JPM formed between 2004 and 2006, most other perpetual funds abroad came into existence post-2017. Floating of perpetual funds and fundraise globally has picked up momentum after July 2021. In that sense, India has not missed out much. India is an evolving market and AIFs have gained importance in India over the past 3 to 4 years. The next instrument to be considered by the fund managers and investors could be the perpetual funds.
There are a few structures available already in the market which resemble a permanent capital vehicle. So, for example, for the real estate space in the last few years, the SEBI has come up with real estate investment trusts. We call them REITs. And similarly, we have a product called Investment Infrastructure Trust, which is popularly called an InvIT. These are all listed vehicles and very akin to what is a permanent capital vehicle. What we don't have is a pure play SEBI registered permanent capital vehicle for holding investments in other companies. The option that we have under our regulations today is what is called a holding company, a deemed NBFC, which is regulated by the RBI. So it'd be interesting to see how the SEBI is looking to carve out a PCV structure so that there is no overlap with what the RBI already regulates.
SEBI's proposition comes at a time when doubts around alleged inflated valuation of companies, especially startups, are doing the rounds. More recently, the Supreme Court of India had constituted an expert panel to investigate if there are any irregularities in the securities market in light of the Adani Hindenburg case. If SEBI approves PCVs in India, it will allow asset management companies in the country to participate in patient and long-term funding. This means that AMCs will start investing in companies with good corporate governance practices and strong financials over a long period of time. So, how will the investment scenario in India change if SEBI allows PCVs within a regulatory framework?
For the concept of perpetual bonds to take off, we may need some regulatory changes in India in terms of investment patterns of long-term investors. Also, some fund managers wanting to invest in startups that can take long to turn valuable may opt for perpetual fund route rather than AIF, as they may not want to worry about liquidating their investments within the given life cycle of the fund in an AIF format, which is typically 8 to 12 years. Investors putting a slice of their wealth in a PCV would be betting on comparatively slower growth.
It would be much better, I would say. I think, there are certain industries which is looking beyond funding, beyond helping liquidity, beyond helping the management 7 to 10 years, which is right now, given in an alternative investment fund. If you look at the growth has been, phenomenal. 5-7 years growth in alternative investment has been roughly around 38%, right? That's amazing growth. Vis-a-vis what other, similar instrument in the country has seen roughly around 22-23%. Now that will really gallop to a much bigger height, because then the pressure to exit by PE funds or venture capitalists is not there.
PCVs have been gaining popularity in recent years. Experts believe the time is right for the SEBI to explore PCVs, which can change the alternate investment fund landscape in India. AMCs may change the strategy by preferring PCVs over startups and look at high returns over a long-term period. It remains to be seen whether SEBI will finally allow PCVs, and if it does, what will be the regulatory framework.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.